Good morning, everyone. Welcome to Titanium Transportation Group's post-second quarter 2020 results investor update. Presenting today, we have Ted Daniel, President and CEO, Alex Vu, Chief Financial Officer, and Marilyn Daniel, Chief Operating Officer. Just as a reminder, there will be a Q&A session following the presentation, so feel free to add any questions to the bottom of your screen. And before I turn it over to Ted, I'd just like to remind everyone that certain statements that are made on the call today may be forward-looking. So in that regard, please refer to the risk factor section and cautionary provisions that are outlined on the company's presentation. And that presentation can be found on Titanium's website. So with that, I'll turn it over to Ted.
Thank you, Jason. And I appreciate let me just get this a little closer, the effort that you and Deborah have put into organizing this. Okay, so without wasting any more time, future of trucking, Titanium. Titanium is what I would call a tech-infused leading-edge transportation company. One of the reasons that we are tech-infused is because, as you'll see in the presentation, a lot of the senior management did not come from originally the trucking industry. We brought various skills to the table, including, to some degree, my background and the approach that I would take. You'll see that my background is technology as part of my training and previous experience. So, in general, from an industry perspective, technology, as it has always done historically and will continue to do so, will aggressively, now more than ever, transform industries and will transform the way we live, the way we do business, and it'll continue to transform the transportation industry, and it'll do so at a more rapid pace than it has ever done so in the past. Titanium will continue to be at the leading edge of that modernization. We are a trucking company and a logistics company. 2/3 of our revenues are asset-based, and 1/3 is non-asset based, so we're a broker. And we consider that we are in a disruptive stage of this particular industry, which is drawing a lot of attention now, especially with COVID. Everyone now, if they hadn't paid attention in the past, we're an essential service. Everyone is, thanking, the grocer, the frontline workers, and the truckers. So, people are realizing that supply chain is an important component. What's interesting is that it's been extremely, for us, especially the foundations that we've got built into the business, and the type of customer base that we've got and the diversity we've got in our customer base, it's been extremely resilient and has been able to sustain these type of extreme economic challenges, and as well as grow to some degree in these times of challenge. And in fact, the irony here is I think it's actually going to also create some opportunity for us. So from an asset-based perspective, we have our head office in Bolton in Southern Ontario. We have terminals that we own in North Bay, Bracebridge, Napanee, and Windsor. And we also have 2 brokerage offices in the U.S., one in Charlotte, which is our U.S. head office, in North Carolina. We also have Nashville, Tennessee. So as disruption continues to make its way through the industry, another opportunity that we'll be able to capitalize on is the M&A. We do have a proven track record of M&A, so we do grow both organically and inorganically, and we will be able to take advantage of M&A opportunities. It is an old industry, highly fragmented, and I believe that that's where the consolidation opportunities are going to exist. On our trucking side, we are entirely a full truckload business where we take raw material to manufacturers or components and components to finished goods manufacturers, and then we will also go from the finished good to the distribution center. So we are actually, at almost 500 tractors and 1,400 trailers, most of which are vans. We also have a flatbed division. We are 2/3 cross-border truckload into the U.S., and the other 1/3 is domestic revenue. We will go all the way to the distribution center, i.e. the DC of Walmart or Canadian Tire DC or Home Depot DC. We don't do last mile. So we're not competing with companies that are trying to deliver a box for Amazon to your front door. In fact, what's great about the way we've got the company set up is that we're agnostic to whether or not you're buying some of your, whether it's groceries, you're buying stuff, whether it's a pair of shoes at the local mall, or you're buying those shoes online. If we are delivering consumables to the Canadian Tire DC, we're agnostic to whether or not you bought those items online or at a physical bricks and mortar environment. So we are very well positioned to continue to grow the business and take advantage of M&A opportunities, regardless of whether there's a shift one way or the other, whether it's during COVID, before COVID, or after COVID, in terms of the online versus bricks and mortar consumption. So very quick, this is the board, myself, and Lou Galasso, who's also a CA and has an ICD designation. Bill is former retired general counsel for BFI, has tremendous experience and is not only an LLB but also a CA. He is the chair of our audit committee, and we're also very honored to have had for the last couple of years since his retirement, David Bradley, who is the former Ontario Trucking Association president and former president of the Canadian Trucking Association as well. So again, to sort of reiterate that tech theme, my background is computer science. So I have a degree in computer science and I have a degree in business, and I also did my CA at KPMG. So after that, few years of turnaround management in the manufacturing space, and then I basically had an opportunity to start this business, and that's kind of how we got going. We started as a small broker, and I'll get into the next slide, which gets into that. Alex has a great background both in industry and public practice, also double major economics and accounting. So huge addition to the team as a CFO. And Marilyn's background is through the Attorney General education from U of T in political science and history, and has tremendous experience at the regulatory and the legal environments that you need in order to understand different aspects of this business, particularly insurance, regulatory requirements, et cetera. Marilyn also serves on the Ontario Trucking Association Board of Directors, and she's also on the Northbridge Insurance Best Practices Safety Council. And in addition, she's also got a Director of Safety certification through the University of Florida. So again, quick history of the company. In 2002, we started the company as a small brokerage, non-asset based, and we grew. We got our first truck in 2005, and then during those couple of years, in order to really set up the company for significant growth, I brought in a private equity group. That group is called the Zen Group of Companies, which is if you look at the first slide, you'll see that that's people that make up primarily the Trunk East investment. In 2011, we did our first acquisition, and we did 9 acquisitions over the last 9 years since 2011. And in the last 2 years, we've grown primarily organically. And a lot of these acquisitions involve the expansion to a number of these terminals. So some of them were companies that were, maybe a second generation that was perhaps tired or struggling or just weren't interested in the business, and they wanted to sell the entire opportunity. So we had some really great opportunities. One of the reasons why we slowed down in terms of acquisitions the last couple of years is not for a lack of looking or a lack of, in theory, opportunities, but in 2018, there was absolutely an insane year in transportation, and essentially truck transportation companies were experiencing record EBITDAs. And at a time of record EBITDA and record multiples, you're basically, paying top dollar for your top year, and there's not a lot of upside to that. So really, it's not an accretive acquisition to our shareholders. So that's why we were very careful to make sure that we didn't pull the trigger on anything that had a huge amount of goodwill and basically on a discounted cash flow basis just had really, really low rates of returns, and that just would not have made sense to the durability and the resiliency of our business. And the result is obviously that we've paid down a significant amount of debt in the last couple of years, to the point where if you take out the IFRS 16 impact of the head office lease, we're down to actually less than a 1-to-1 debt to equity ratio. And give it a few more quarters, technically we could be almost debt free. So we'd be virtually a cash positive balance sheet, and essentially a debt free company ready to pull the trigger on any opportunities that are going to be available to us over the next couple of years. We opened Charlotte in 2019, our first U.S. brokerage, and they're outperforming at this point in time. And Nashville has only been open for about just under 2 months, I'd say. We started July 1, so Nashville is also outperforming. They're basically having record months, which is really fantastic and really exciting. Our goal is to open up more offices, and there's a really great slide coming up on that. So great example of our diversity in terms of our customer base. So you can see there's tons of ingredient companies. So whether it's a P&G or Novelis Aluminum or Worthington Steel, these are companies that supply chain. So for example, Novelis being a very large multi-billion-dollar aluminum manufacturer, their aluminum goes to make aluminum cans that goes to Coca-Cola or Pepsi, or it goes to, let's say, an F-150 manufacturing plant that makes components that go into the F-150. So I look at basically, whether it's Coca-Cola or a beer can or an F-150, these are staples. People are going to keep buying these staples, especially during tough times. And so that's why these are really great ingredients, whether as well it's pulp and paper going through Cascades, or Kimberly-Clark. Obviously, everybody, remembers the toilet paper obsession for the first few weeks of March, where everybody went bananas, and we all bought an insane amount. So basically, what we're looking at here is a highly diversified CPG or CPG ingredient company, and extremely resilient. So this is what I believe has been one of our key success factors in not just weathering the storm, but in a way benefiting, from a challenging environment. We thrive because we're good at it, and when times are tough, we kind of counterintuitively tend to thrive even more so than even in easy times, just because it really puts the company to the test, and then that's when we innovate, and our IS and IT teams are getting even more creative, and people are just really motivated to just kind of build an even better company. So in addition, highest customer dependency is 6.7%. It's rounded to 7. So on the decimal there, I got a thumbs up from my CFO, so that's really cool. I didn't screw that one up. But basically, yeah. So we've got all the right ingredients to keep growing, and as the Canadian and American population continues to grow, consumption will continue to grow. We're going to continue to grow as a business, and as well from our tech perspective, we'll be able to keep buying companies. So these are our platforms. The Trimble platform, head office is in Ohio, in Cleveland, and the TMW, the Transportation Management System, is out of Cleveland, and we use a very large platform, SQL based, and that's why we have a bunch of SQL DevOps guys, and that's how we innovate. For a small company like Titanium, which I consider small, we run a shoestring budget basically compared to like your C.H. Robinsons and J.B. Hunts that are running hundreds of millions of dollars through their R&D department. We're able to innovate and do some of the things that big, large, multi-billion-dollar companies are doing. So we're really excited about that as well, because we kind of consider ourselves sort of like the little engine that could, or call it the little big fleet. So from that point of view, we're actually pretty excited. We do use the latest and greatest of technology. We got 5 Teslas on order. The Class 8 trucks that they're innovating, and hopefully they'll be arriving next year. Isaac Instruments is also a Canadian satellite company, and our trailer tracking is BlackBerry. But what's really cool about the Isaac Instruments company is that, again, they didn't actually come from truck transportation. Their background is actually F1 analytics. They're a really, really super innovative company. They run a GTAC, which is actually a ruggedized military tablet. It is open source, so that is the future of trucking. They're plugged right into the engine control modules of our trucks, and all of that is integrated through satellite into our databases, and we're able to pull significant amount of real-time data that runs into all sorts of dashboards that a lot of like really cool red, yellow, green stuff, and it almost looks to some degree like a little bit like a bunch of screens at an F1 at an Indy 500. So it's really great technology. Again, they're really killing it, and they're growing, and they're innovating, and we're glad to be a part of that system. And the other thing as well is with BlackBerry, what attracted us to us is, again, same deal. They're more of a software company today than they are hardware, and that's really exciting for us. So we're able to work with that. And the other thing that we have, and we'll get into that, is on the insurance side, and that is something that also is driven by our IT capability. So I will mention the fact that, yes, disruption is coming to the trucking industry. It all comes back full circle to the whole IT, the whole technology thing. And yes, let's say over the next 10 years, you might start to see a little bit more and more of the kind of, on an isolated basis, the autonomous truck component. I don't think it's going to be something that you'll see on a mass scale out there, but you will see more and more of that. And it's not about the autonomous truck. It's about the ability to integrate into the autonomous truck. It's how do you run that vehicle to some degree for a part of the lane when you're not there, or maybe the autonomous truck will have a driver, but the driver will be off duty in the back of the cab. So, what are you doing from an integration perspective? And that's, again, all part of the whole technological capability of being able to integrate into your equipment. So that takes money and it takes time. And that's where Titanium is actually that kind of techno trucking company that continues to innovate, but has been doing it for many years, and we're not new to it. So we keep investing in that area, and we keep doing it. As well, the next major disruption is that we're the first trucking company to have layered a blockchain technology with Walmart. It was Walmart's initiative, but customer demands will increase. They'll continue to increase, and customers today are no different than you and I. Basically, this is how we live our life. Customers want that level of visibility. They want that level of convenience, and they want that level of customer experience. So customers want vendors that can give them the type of experience that they're used to living. It's no different than, a traffic manager at or VP of transportation at Home Depot goes home every day, and if he wants to see where his package is because he's ordered a new pair of shoes from wherever, and they're on their way, and he wants to be able to track it. So we have that ability, and so our customers are behaving in the same way as we're all behaving day to day, which is we want convenience, we want an easy experience, we want that customer experience. They don't want to be overthanked, basically. What they want is they just want to go home every day knowing that the conveyor belt, the digital conveyor belt, is running smoothly. And that's what we're all about, is the EDI, the integrations, and so on. And so we are living up to those expectations and continuing to invest in those areas. We actually ended up on an advertising video through Walmart on their initial blockchain integration, which is really cool. So that's a great recognition to our IS team, and they did an amazing job with those APIs. Again, the regulatory environment as well is and continues to evolve. More regulations. ELDs in the U.S. came in 2018, and Canada will have them mandatory. And the Canadian Ministry of Transportation basically said, we're not postponing it. It is mandatory. It will come, and it's going to come June 2021. So we will have electronic logging. There will not be any more paper logs in Canada effective middle of 2021 and onwards. So you're not going to get guys that are running on multiple paper logs between here and Vancouver and doing it illegally. Every truck is going to have to be monitored, and it's all going to be plugged into the ECM and the satellite systems of the truck. So that is going to be a major change in Canada. We believe that's going to get rid of a lot of bottom feeders, your 2 to 5 truck micro company that runs off basically the load matching internet link services. Biggest one being LoadLink in Canada. And we believe that that's going to get rid of a lot of sort of that really bottom end kind of, low end competitors that are also driving costs down or revenue down in a highly fragmented environment. Mandatory driver entry level training, that's been in Ontario for a couple of years, for about 3-4 years, but Canada finally just made it mandatory. I think it was a few months ago or early part of this year, sometime in the spring. So we believe that that's also going to have an impact on capacity. And Canada right now does not have a domestic drug and alcohol testing program. However, we will have that in the future. They do have mandatory drug and alcohol testing in the US. We don't. So not sure if they thought that through when they made cannabis legal. But yeah, technically you're not supposed to have, you're not supposed to be behind the wheel in general if you're going to blow over or you're high. But the thing is that we don't have for commercial drivers an official program in Canada, which that will come, and word on that is potentially as early as 2021. So that is going to as well reduce capacity. If you're a cross-border carrier like Titanium, all our drivers are tested. So obviously we've been very accustomed to that environment. Insurance underwriters. So this is an interesting also evolution. If you go back about 10, 15 years, there were like somewhere in the range of 8 to 10 underwriters in the commercial truck transportation space. It's now down to essentially 3 large underwriters, and the rates are going through the roof for most of them. We're seeing examples of companies that have high loss ratios that aren't even viable anymore, that are just, shutting down, or guys are winding down saying, yeah, I've been at it for many, many, many years. I'm 64 years old, or, 68 or 73 or whatever. And yeah, I'm thinking about retiring. Do you want to buy my company? And they're not even viable, and they're just winding it down, selling the equipment, and just basically taking out whatever little equity they have left. And that's because you're seeing, there were times where you're paying $4,000 or $5,000 a truck. There's guys that are hitting now, owners that are hitting as much as $15,000 to $20,000 a truck. So that's extremely expensive. Anything beyond that, you get into what's called provincial facility, and it makes it almost impossible to operate. That is a good thing, because it will force more safety. I kind of want more safety on the road. I don't want people running around worrying about whether or not they're going to get crushed by an 80,000-pound tractor trailer, that needs basically 3 football fields to stop when they're going at 105 kilometers an hour, and will cause a lot of damage. So you want drivers that are out there that are compliant, and that's a big part of Titanium. So because we're a very unique company, we're actually the only trucking company in Canada that has a very unique program with Northbridge. They're one of the largest underwriters of truck transportation insurance. They're owned by Fairfax, and we have a very unique program with them. They're actually plugging into our analytics, and they're developing with their IS department, through our IS department, in collaboration with their actuarials, and analytical and and a statistical program that is using data that's coming directly from our trucks. We have a very unique program, and as a result of that, we have a deal for the next several years with Northbridge that we actually have very low insurance as part of this joint program and this research project. And so we have kind of one of our, I guess, sort of secret ingredients as well that are coming through this heavy investment in IS. So, you know, from our point of view, we're actually really excited to be a part of that. And the other part is that we're actually helping the insurance industry develop better analytics, you know, better programs that will be able to judge companies that are compliant and companies that aren't compliant, and companies that are, you know, financially or mathematically safer versus the ones that aren't mathematically safer. And so to me, I'd rather rely on math. I'd rather it not be subjective, and I'd rather see insurance companies reward those companies that deserve to be rewarded. Let them be more competitive. Let them be the ones that have a competitive advantage over the ones that aren't as compliant, aren't as safe, both from a moral and a business and a mathematical perspective. So that actually is something that, you know, we're very excited about. From a supply and demand perspective, top level economics, again, we're really well positioned. So a company with such a strong balance sheet like Titanium will be able to take advantage of the situation. Essentially, you know, whenever you have a slowdown, because of the fragmentation of our industry, capacity contracts. And so there you have the elasticity in our cycle. And you can see that over and over and over, where you've got an increase in trucks, rates come down, and this is on the brokerage side. So it's very much like your typical stock market kind of commodities type of environment. As capacity shrinks, so this is your truck index is the dotted line, rates go up. And this is all spot market right here on these charts. And you can see the crash on the red line. Incidentally, July is a slight up. It continues to increase. So July is right about here. It just came out yesterday from LoadLink. So it is a slight upslope. But you can see the crash. So this chart it's almost at the bottom of the chart. And of course, you know, I haven't seen that in, you know, well over 10 to 15 years, this level of pricing. So this has obviously, to some degree, beat up some of the capacity. And of course, you're seeing some of the recovery on the spot market. But what's interesting is that, you know, you can argue, well, okay, spots went down, now they're back up, everyone is fine. Well, not exactly, because the small trucking companies don't have the balance sheets that have our level of durability and resilience, aren't going to be able to sustain this. And so if you think about it, all you need to do is think about, say, you know, you've got this slide here, which tells you you've got 97% of US and Canada's close, 97% of US trucking companies have fewer than 20 trucks. So all you need is this little company that's really living paycheck to paycheck, that's living month to month, to really shrink by one truck. That's 5%. And 5% is a gigantic number. That's assuming if 97% of trucking companies across Canada and the US shrink by 5%, that's pretty much a capacity crisis. And you're basically potentially headed for another 2018. But what's really exciting about that too, is that it's not just about a 2018, which is just an ELD issue in the US. It's more than that this time around. It's the fact that in 2018 and 2019, you had record equipment orders. So everyone went and bought out. They all thought that this was sustainable, and it wasn't. And they all went and bought a ton of equipment. When you buy trucking equipment, you're not buying equipment and, yeah, well, here's a big fat check for a $180,000 truck. You're basically buying that piece of equipment, you're putting it on your balance sheet, and it's going to take you 5 years to pay it off, or 6 years or 7 years. And, you know, it's not much different than the auto industry. You got people that are buying cars now and taking 8 years to pay them off. So it's the same concept. A lot of these companies are very leveraged. They've got a lot of loans, and 2018 was only 2 years ago. And then COVID hits, and they're not even halfway through the payment plans on trucks that they bought 2 years ago. They're not buying capacity at the same rate that they did 2 years ago, thinking that this was sustainable. And so the recovery is not only sustainable, will create a capacity crunch, it will actually be potentially recovery that will actually have some durability to it and some traction, which is something that I'm actually very excited about, especially for a company that has such a severely under-leveraged balance sheet like Titanium. And again, you've also got consumption. We're going to keep bringing in 500,000, 600,000, 700,000 people into Canada every year. They're all going to need to consume. They're all going to go to Walmart and Canadian Tire, and they're all going to be buying, cans of beer. So that's really awesome for me, for us, for our company. We're going to do really well on all of those levels. Financial growth, again, your basic, up, digest, flatten out, increase, digest a bit, flatten out. Again, margins shrink a bit and then they go back up. So, but overall, it's definitely an up curve. This is a up to the right slope, and it'll continue to do so, averaging out the years that, scale back a bit, you spend a bit more money on growth, and then you benefit from that over the following, 12 to 24 months. As you can see, revenue continues to grow to some degree. This little bit of slip here is obviously that is top line. That is top line due to fuel surcharges. So when fuel was higher, then you were charging a bit more. This is a little bit of slippage in 2019, and as well there was a bit of a pricing variance. But again, that's that surge in capacity, and then you've got that surge in demand, but then you've got the overcapacity, and this is going to continue to grow over time. And again, it's going to be your essentially your projectile that is going to continue to grow on average, upwards to the right. We've invested in tech, we've invested in the right people. We're the only trucking company in Canada that has both an employee and a driver share purchase program, which also gives us virtually zero turnover. We have single-digit % turnover. It's very minimal. We've got the navigation tools to go with it. Corporate culture is extremely powerful. And so the company is extremely well positioned to continue to grow, both from a people and technological perspective. We've been on the growth 500, I think, 11 or 12 years in a row or something. What is it, 11? 11. We're 11. We've applied again. Mathematically, I'm not going to be surprised if we're on it again, because we do continue to grow. So I kind of know what the parameters are. But anyways, moving right along. Strong free cash flow, healthy balance sheet. We generate a lot of cash for an asset-based trucking company. That's very unique. Most of them tend to be cash neutral only because they're a zero-sum game. They're buying trucks. They don't know their costs. They don't understand it. They didn't come from, the background that I've got in manufacturing, where, you're right down to the fourth or fifth decimal place when you're producing, a widget that's going into an F-150, at a tier 2 automotive level. So, basically without that manufacturing level of detail that we have in our type of analytics, you don't get the kind of understanding of how to make money, and even more importantly, how to pay down debt and generate cash. And cash is good because shareholders love cash. I love cash. Everybody loves cash. And, especially if you're going to make money, but then we get to decide, well, are we yielding, or are we going to use that cash to grow? And really one of the things that I think are really going to generate a huge rate of return is the fact that we're going to invest all this extra cash that we've got now, which is about $40 million worth of dry powder. And we're going to use it to buy over $100 million in acquisitions. And again, 18, 19 were years where we were looking at a lot of opportunities, but we didn't pull the trigger because for various reasons, each one on their own unique basis didn't make sense. We did go deep on a number of opportunities, but just couldn't hit the finish line, whether it was a company that just wanted too much money, or is a company that really was way too far gone in its ability to be turned around. So from that point of view, we made the responsible choice. But we believe 2020 was going to be a very acquisitive year. But again, COVID basically just put everything into delay mode. So that's okay. We generated more cash in Q1 and Q2 of 2020. So we went from beginning of this year, we're at 30, close to 30 million, it was around 32, 33 million of dry powder in the barn. And now we've got around $40 million dry powder ready to trigger on any opportunities. And working backwards, if you do the math, that 40 million is going to buy us anywhere from 100 to 150 million of top line revenue and 14 to 16% EBITDA in the trucking space. Our U.S. expansion is purely non-asset based at this point in time. The U.S. market is 700 billion with a B, billion. Anyways, so 700 billion as over the road, and that's the truck transportation market. So roughly, if you convert it, it's about $1 trillion Canadian. From a brokerage perspective, a small broker in the U.S. is 20 million per office. Right now, we are exceeding expectations with both Charlotte and Nashville. Little healthy competition. They're doing really amazing and giving our Canadian broker a little competition, which is kind of awesome. So we're really enjoying it and having a lot of fun with that. So our goal is 5 offices in under 3 years. One more office this year would have been the goal, but that's a little delayed again because of COVID. So hopefully early part of 2021 will be a 3rd office. And again, our goal is 20 million per office US. That's 100 million US. So top line, we believe that we're going to be able to achieve at least another 100 million in revenue on non-asset, non-levered basis over the next, frankly, 1 to 2 years, depending on how quickly we can execute on the next 2 to 3 offices. Yeah, I mean, if anybody has any questions on how we're executing on this, feel free to reach out, but just very general. We do have a director of operations that is American. He comes from senior management in the brokerage industry in the U.S. from about a $600-700 million broker. So he's got tremendous experience, and he's got a huge amount of contacts down there, and he's very, very excited about the opportunity. So really just we've got the right people in place to be able to as well execute on this plug and play opportunity from a tech perspective. I mean, we're able to basically cookie cutter these offices right now to the point where it's almost like a Tim Hortons McDonald's formula. You know, we have the formula, we know the size, we know how to furnish it, you know, we know what tech goes into it, how to plug it in, and we've got all the systems, the CRMs, et cetera, and we're able to basically open these offices, and from day one, they're practically opening their doors and selling, selling transportation. So consolidation, again, I mentioned 97% of U.S. trucking companies operate with fewer than 20 trucks. Highly, highly fragmented. I heard a great joke. The only other 2 industries that are as fragmented are babysitters and landscapers. So it's insanely fragmented, and it is due for consolidation, and it's long overdue, quite frankly. And I think it's going to be the tech and people at tech companies or tech trucking companies that's going to consolidate. It's going to be a tech haves and a tech have-nots. And tech is relentless, it's unemotional, and it will rip through the industry, and it will rip through all of those companies and leave basically nothing in its wake other than those companies that will survive and will become tech leaders in the industry, and all the rest will just become basically subsidiaries of the the tech leaders in the industry. So that is clear. It's not a if, it's a when, and it's going to happen a lot faster, obviously, now than the type of industrial revolutions that have happened in the past. So this is going to be an industrial revolution for the transportation industry, and we're definitely investing in the areas that will make us and it will continue to keep titanium on a growing leading edge front. Again, the U.S. industry is ginormous. So for us, initially the non-levered opportunity is tremendous. In Canada, there's over 65,000 trucking companies. Again, not surprisingly, 41% of the population is in Ontario. So 41% of Ontario of trucking companies are in Ontario. Similar demographics, throughout the rest of the country. You've got 1 million people in the province of Manitoba. That's a demographic challenge. So again, one of the things that are challenging in the Canadian market is just our mass geography and lack of critical mass in a number of these areas. So, definitely you're going to see a lot of growth in our Ontario market. We do dabble out west a bit, but not much. And, hopefully you'll see some growth in those areas over time. And then as well, out east, we do some Quebec work. But again, 2/3 of our volume is in the 500 to 1,000 mile radius into the U.S., which is where most of the industrialized density is in the U.S., right? You're not going to see a lot of trucks going into Montana just because there isn't a lot there. And again, it's just driven by consumption, industrialization, and demographics. And another really interesting stat is that the top 100 carriers in Canada only account for about 6% of our capacity. So the other 94% is all the other carriers, which are going to be your, basically mini to micro size carriers. And they will over time, just because of all these evolutions, right? The insurance challenge, the cost of equipment, which, they're limited on a leveraging perspective. Their tech capability just isn't there. They don't have the critical mass. It's going to be more and more of a challenge. And so you'll see both consolidation opportunities in the industry, and you're going to see organic opportunity, because some of them are just going to, wind down organically, and some of them are going to sell at the right time. What I find with sellers is they typically don't sell early enough. They wait a little too long, but you know what? That's just part of the M&A game. So again, proven track record of integration. We like to integrate because that's how we get synergies out of the situation. We have the tech, so we plug in our tech. We go in, we have a 30, 60, 90-day integration program, and we basically, execute on, on these efficiencies. A lot of the synergies are because of automation, and so we typically centralize our G&A. What tends to be a little bit more decentralized is the actual operations, but because of our technology, everything is on a shared platform, so we're able to immediately be able to integrate the utilization and the efficiency and profitability of these companies. So, if we were to buy a company even for like a 5 or 6 or 7 times multiple of a 8% EBITDA, we're easily able to knock that multiple in half, because we're able to increase the EBITDA to 14, 15, 16%. So from that point of view, that's to a large degree the mathematics of what we're evaluating. The goal is, we're high ones, give or take. We're almost a $200 million trucking company and logistics company, very heavily vested in IT and IS, heavily vested in our infrastructure and our people. We're going to continue to broaden that customer base and our geographical presence through both organic and inorganic growth. The investment highlight is the diversified customer base, our tech, our people, our proven track record of integrating our M&A, and our extremely under-levered and cash-rich balance sheet at this point in time. Our ability to generate free cash flow from our efficiencies and our profitability. We've got a highly aligned and very engaged management team and employee base. And of course, this is how we continue to grow our shareholder value and maintain our durability, resilience, and sustainable profitable growth. So to grow to a $500 million company at this point in time is achievable, and it's visually attainable or mathematically attainable. I am seeing a first question here. Can you hedge fuel costs, stay away from expensive areas like GTA in which to locate but still operate? Yes. So a couple of questions. We don't typically hedge fuel costs, only because fuel itself is built into a large degree into our rating systems. There is a fuel surcharge program. So if you guess wrong on the fuel hedge, you're actually going to be at a significant disadvantage. So we do have flow-through fuel surcharges. We call them FSCs. There are charts and tables that are out there. Most customers will have an FSC table that is negotiated as part of their rate tables. And so that's how we're able to adjust. You have some customers that basically don't have a fuel program, but again, because of the elasticity of the industry, if we're not charging enough, customers going to know about it. The industry isn't going to allow them to go elsewhere just because rates will increase anyways, and so on and so forth. If we're uncompetitive, on the other hand, and there's a severe decrease in fuel price, we're going to obviously have to adjust the rate. So it is very flexible that way. Stay away from expensive areas. Yeah. So I mean, again, we are long haul trucking. We don't have terminals in the GTA, but we do some local moves. But we're truckload. We're not doing local deliveries like last mile and stuff like that. So
just to add to that, we do run a fuel program, so we do report weekly to our driver pool in terms of where are the best areas to fuel based on rack pricing. We do have significant volume-related discounts on our fuel. We are constantly renegotiating our programs with our fuel suppliers. Recently, we've made a change to a comm data network, which is a little bit broader with some steeper discounts for us, both in Canada and the U.S. So we do definitely monitor our fuel rating across the board and in geography.
Yeah, we buy millions of liters of fuel a year, so we have significant pull with the large fuel suppliers at the diesel commercial stations. So again, the GTA that's not an area that we focus on per se. That's more, I guess it would be last mile. I'm not sure if I'm answering the question correctly, but yeah.
We actually have some other questions here. Just building on that last fuel question, could you provide the impact of a 10-cent move in the price of diesel fuel?
Like a 10-cent move up or down, we would be very elastic in that most of our big customers have what's called a base rate and then a fuel surcharge, which is adjusted typically monthly. So if the fuel goes up, then we would get an increase in our fuel surcharge based on the tables.
I can just add to that quickly. So I would say largely almost all of our contract freight, so contract being, your year-long contract, sometimes longer than that, our base rate plus a fuel surcharge. We are talking about the asset-based side of things. When you have freight that is uncontracted, which there's not a lot, to be honest, in our fleet, but if there is some, and there is some, fuel increases are usually one of the best ways to negotiate with your customer in terms of adjusting pricing if need be. It can swing both ways, so there is a level there to be careful with. On the logistics side, it's completely elastic. It transfers between the carrier and the customer as a broker and as an intermediary. Up or down, the margin stays about the same.
Yeah, so that's kind of an important distinction. On our asset-based fleet, we are primarily, like almost all of our revenue is contracted revenue, which has a fuel surcharge program. On the logistics side of our business, it's primarily, as a third-party broker, it's primarily almost daily spot rates. So it's kind of like, it's basically like a commodities exchange. And it is sometimes like that in the environment. So you will get the pricing fluctuations are going to be spots. So you're basically negotiating a margin. And actually, it's funny because when fuel goes up, as Marilyn said, sometimes when fuel is expensive, we actually make more money than when fuel's cheap. We get a slightly better spread.
Great. And then I guess on that, what is the typical length of a contract? And then also, how much of your business is priced off spot pricing?
So on the trucking, so your asset-based trucking segment, we're close to 100% contracted freight, and the length of the contract is typically 1 year. We do have some that have 2 and 3 year contracts, and they have adjusted rates for each year as on an increase. But largely, the most common now is 1 year. You do occasionally see short 3-month or 6-month contracts for smaller amounts or smaller lane bids, but that's typically about 1 year. On the logistics side, most of our freight is spot. So when I say most, I'm going to say 80-90% is spot. There's the other contracted freight with some of our blue chip, like your Walmarts, your Loblaws, that have contracted lanes, pieces of it that is contracted, and then above that you have spot freight on those customers as well. So on the trucking side, we have very little spot. Generally what we'll use spot rate for is inbound freight from the US that may occasionally require a, in the moment, sort of brokerage load. And on the logistics side, again, the spot is majority of the business that we do.
Yeah, it kind of evolves to your typical 80-20 rules, you know, yeah, like it's kind of a good thing in the sense that you don't want to be 100% contract, but you also don't want to be heavily spot. What's good is that the two businesses kind of offset each other in terms of risk. You know, if you're locked into a long-term contract where you've got a little bit of volatility, then the brokerage side of the business is great to be able to overcompensate for the volatile lanes.
Can you also talk about customer concentration risk and how much does your largest customer represent?
Okay, yeah, so again, we have very little. I don't know if everyone can still see the presentation. So again, we have very, very little customer concentration. Our largest dependency is 6.7% of revenue, but it is a packaging company. So it's packaging that's going to companies that are basically selling you food. So for example, Nestle is one of their customers. And so it is going to continue. There's demand for that ingredient. Again, that's because that's such a staple, and think of us as part of their production line outside of their four walls. That is about 80% of what we do for them is contracted. So there is no real risk in that sense. Very little dependency, very little customer concentration. We are well diversified on all of the different industries. So even in terms of your 6% customer and all the rest are even lower than that, there really isn't a risk from that perspective. And even if you lose a 2 or 3 or 4% customer in theory, that's easily replaced because of the level of sophistication that titanium and our size in the industry, you know, so that from that point of view, I don't really worry about, that's not one of my worries. I don't worry per se about customer dependency.
I think also customer dependency is very true, but we're also not industry specific dependent either. We have done a good job over the years in sort of making sure that our risk is spread. There isn't one area that we're highly dependent on. We do a lot of raw materials, but we spread it out between everything from consumables to paper products to steel to lumber, finished goods. So we've done a good job in having a good diverse both customer dependency or lack thereof and industry overall. And that's been really lucky for us, I suppose, during these COVID times because we were able to weather through it very well. And that's part of it. Whereas a lot of trucking companies or a lot of transportation companies in general sometimes will focus too heavily in one area. For example, the automotive sector. There's lots of transportation companies that focus very heavily in automotive, and that would have been a tough thing to weather during COVID times. So hope that answers that question.
And just to add on, just to give you some examples, and Marilyn brought up a really good industry to talk about is automotive, right? So if you look at previously, in previous quarters, even for titanium, automotive represent almost 10% of our total revenue. And with COVID, can you hear me? You can hear me, right? Yeah.
Yes.
Okay. So with COVID, a lot of the automotive sectors shut down entirely, and you can see we also were affected. Automotive dropped to 3% of our total revenue for Q2. But if you think about it, our total revenue didn't drop that much. Obviously, it's affected by COVID, but that's because we have such a diversified customer base and industry base that we can say, okay, so our auto is shut down. We can move all of that capacity elsewhere in other industries to cover for that. Obviously, it won't be 100% one-to-one coverage, but it will alleviate a lot of the pressure we have in terms of having too much capacity during these times.
Yeah, there's definitely a shift, right? You see less automotive, that means we're doing more, for Home Depot, Canadian Tire, whatever, right? Which gives us that flexibility.
Could you provide a typical life of a tractor and separately a trailer, and then how do you count or depreciate these assets?
Yeah, so we use an 8-year life cycle calculation for our tractors. And trailers, if it's a dry van, it's an 11-year life cycle, and if it's a flatbed, it's 15 years. So that actually is pretty important math, and it's a really great area that actually gets me pretty excited. It's the fact that if you think about it, if a tractor is going to last you 8 years, that means that you've got 1 divided by 8, which is a 12.5% essentially depreciation straight line per year. That follows to some degree the fair market value after about 6 years. So you will be able to sell tractors for roughly that amount on the books. However, what's interesting is that there are a lot of trucking companies out there that we look at, lots and lots, that aren't generating a 12.5% EBITDA for a tractor. And what's interesting is that that's essentially what we call, a trucking company that's living off the death of their equipment. And if you're basically doing that, you're taking out, and if they're not reinvesting in efficiencies in their future, which gets into this whole thing of how this industry is going to evolve over the next few years, then they're not able to generate sufficient cash flow to replace all of that equipment eventually. So it's a matter of time until those companies start to erode from the ability to replace that equipment. So what's happening is you're not getting the capital reserve. So that's why we believe that, we understand heavily, what it takes to be able to replace equipment and invest in tech and understand the real financial numbers in order to understand how equipment plays into the profitability and net free cash flow of a business. With sustainable CapEx, we're still able to generate about $8 million a year of free cash flow towards debt reduction on a zero growth, zero acquisition model. So that's huge, because next year we're going to have to replace some trucks and trailers on schedule, and if we don't technically grow, or if we don't technically buy something, which is highly unlikely, but in theory, just for the sake of arguing a non-moving target, if you were to throw this into a spreadsheet, you're going to be debt-free, completely debt-free in 2.5 more quarters. So 2 minimum, 3 max.
And Ted, could you just speak to more so economic highway speed? So, the trade-off between speed versus tire wear, and then also fuel consumption?
Yeah, sure. You want to? Yeah. Do you want to? I know you like this topic as well, so I'm going to let.
Sorry, Jason. Can you just repeat that?
So my COO is going to tackle this one.
Sorry.
Because she,
Just repeat that, Jason.
So could you just speak to the economics of highway speed? So trade-offs between speed versus tire wear versus fuel consumption?
Sure. So we actually run a fairly sophisticated program that way. We also reward drivers and consider our carbon footprint. We are SmartWaste certified, so part of being SmartWaste certified is it's a carbon footprint initiative that we have with North America, Canada, US.
The US EPA.
Yeah, to kind of measure our output. So with that, we installed into our GPS system, Isaac, we installed a driver coach. So we're tackling speed, fuel economy, idle time, driver events, so hard braking, critical events, things like that all come into play. Certainly speed, idle, and fuel go hand in hand. Obviously, reducing speed increases fuel economy to a sweet point. I shouldn't say, if you're going 40 kilometers an hour, that might not be effective, but safe, but maybe not fuel effective. But there is sort of a sweet point. What we've done is we've installed this program that's connected to the truck's ECM and coaches the driver in real time. So it's a live, real-time feed, kind of like a traffic light, puts the driver in the green zone or the yellow zone or the red zone. The green zone is measuring his speed, his idle time, and his fuel consumption. His goal is to be in the green zone all the time. If he's in the yellow zone, it'll give him a recommendation for either reduce speed or increase speed. It'll set him up. Red means you got problems, and red will trigger back office to go in and coach the driver. So we're very conscious of that. We realize that it is, both is a twofold. It's a win-win in terms of maximizing a driver's performance in the truck for fuel economy. By the way, we do this for owner-operators as well. It's sort of a value-added service to the owner-operators. It also has a ripple effect into safe driving. The more engaged a driver is, the more aware of his actions he is, the safer the driver he'll be. And if you, I don't think we've got any charts in our presentation that actually take a look at Titanium's performance on a CVOR or on a DOT. We are rated as, within North America, in the top 10% of safest fleets in North America with Northbridge, which is the largest insurance provider out there. It's now called NFP. But if you look at sort of our performance over that way, knock wood, we have an excellent safety score, and that's not by accident.
No pun intended.
Use the pun. Yeah.
There you go. Okay.
Use the pun.
God's sakes. It's kind of a really great example. You know what? When you listen to what Marilyn says, it's a great example of how, you know, economics and all of these other things all work together. So, you know, less fuel, you know, we're making the carbon footprint, you know, environmentalists really happy. And I like that too, because, you know, I want to protect our environment, but we're saving money and my shareholders are happy because we make more money and we're a safer fleet. We're not injuring people. So that's a really good thing. So safety, the environment, making my shareholders more money, all of these things are doing what they're supposed to do, which is really great. And they're working together, which is fantastic.
Just on driver shortage side, could you just speak to that? And are you having any difficulty in hiring drivers?
No. We're also of the belief, our group here believes there is no driver shortage. We have never really felt that. Like anywhere else, good drivers are harder to come by, just like good employees are hard to come by. No different that way. Our pipeline right now is incredibly robust. We fill every truck that we want to. I've never really experienced a true driver shortage, and I would argue very, very carefully that there is no driver shortage, because if there was, that would be reflected in margins and rates and profitability in the trucking industry, which it's not. So I think that's kind of an easy conversation to have. But in terms of our business being affected by a driver shortage, it is not. And that's twofold for us in driver retention, which is equally as important as driver recruiting. I do have 2 full-time recruiters on staff, and part of the job is also retention and ongoing training that we involve with our trainers. So we don't have an issue with driver recruiting. Our pipeline's really full. In fact, we have pulled all our advertising. I am no longer advertising in any medium for drivers. Again, most of our drivers come to us by referral. We do have some marketing online, but that's about it.
It kind of, again, works hand in hand. You know, if you have a good company, a great company with a great environment, good tech, good financials, so these guys aren't worried about whether or not that deposit's going to be in their bank twice a month. You know, good equipment, safe equipment, engaged dispatch workforce, an engaged safety department, and so on. It's not, I mean, it's not a sweatshop, right? It's the same thing. Sweatshops have a really hard time recruiting, and they have huge turnover. Companies like Titanium, which have a share purchase program and kind of all of the above, we actually have a lineup of people that want to work here. So in a way, it's kind of good. Like I kind of think the driver shortage is sort of a good thing, but for us, right? Because we don't have a problem recruiting great drivers.
How do you determine where to open a new office?
So
the brokerage side, that question.
Yeah, it's definitely what we're looking at is opening new offices on the brokerage side. In trucking, it'll be by acquisition. But on the where we look for it is twofold. One, it's talent, right? So we're looking at where do our connections and our viability take us to in sort of a next city or next location, as well as where is a customer concentration we can easily tap into. That's what we did with Charlotte. Charlotte was a strategic location for us, both with people and customer concentration. Nashville, same plan. It was people first, and then it was customer concentration. We look at areas that are rich in transport or freight lanes, et cetera, rich in industry, I think just like anybody else would. And then again, our talent. So we're kind of following where opportunities come to us. We have a good network in place. Again, part of our strategy was making sure that our U.S. Director of Logistics was well connected in the industry, which he is. And a large part of our opportunities is coming from his direct U.S. Connections, which we knew would be very important being a Canadian company entering the U.S. marketplace.
What is the value of your head office lease, and how do you account for this on your balance sheet?
It's on the balance sheet for $34 million in debt. And what's the asset value? Same. Yeah, it should be the same, right? Yeah. So the asset value is $34 million, and the liability is $34 million. So if you take the current long-term liabilities, if you want to flip the current portion of long-term debt down to the long-term portion, add that in, and then deduct $34 million, then you're going to see that the total debt load is around $20 million, which is pretty low. It's like 20 and change now. What was the last number? 24, 25? 20 point something. Well, there you go.
You indicated that you have a severely underlevered balance sheet. What level of debt would you be comfortable with?
We are comfortable to increase our debt load to roughly 3 to 1, whether it's debt to equity or debt to EBITDA. But it's not about increasing it to a number that we're comfortable with. I think it's kind of like increasing it to a number that we're comfortable with for the right reason. And if we're going to hit that level of leverage, that's because we just wrote a big check to do a fairly substantive acquisition. And we're going to buy something that we know we're going to be able to extract at least, one or two, be able to shave off from synergies. We're going to be able to shave off 1 or 2 multiples off of the purchase price, right?
So this is kind of a multi-part question here, but what is the percentage of insider ownership? Is there institutional investment? If so, what is their percent?
You want to just verify? Let's go to the first one. There it is. 50.3% is total insider ownership.
When was your last raise, and at what price? Is there currently?
We did a raise. The last time we did a raise was quite a while ago. It was July of 2015, and it was at $285 a share. And essentially, I think maybe if the question is, do we expect to do another raise? My answer to that would be, given the right reasons, yeah, it'd be great to be able to do a raise at a certain stage, because if we're doing a raise, it means we've done an acquisition that's used some of our available cash that we currently have, and then we're doing a raise because we're in need of this additional capital to do another acquisition. So from that point of view, that would be actually really exciting. To do a raise is doing it for the right reasons, and the right reasons is growth. And that to me is, it's very appealing. And is there currently any warrant overhang? I think all our warrants, there were warrants, but they've all expired. So there is no warrant overhang at all. That's gone. Do you have any? Right. So again, in answer to that question, we would love to do a raise, but it would be because we're doing a substantial acquisition, perhaps a transformative.
Just being mindful of time here, there's just a few more questions, and more from an M&A standpoint. Could you talk about M&A metrics? So, how you would structure it, how M&A would be structured? Would there be, would you buy it for cash, stock? Are there earnouts included on that? From a metric standpoint, what do you look at? And then also, how much goodwill is there on the balance sheet?
Yeah, so we're very cognizant of the goodwill portion, because the goodwill portion will highly erode your rate of return on the investment, especially in trucking when you're dealing with, again, your 8-year truck and your 11-year van. So you really, really have to be cognizant of that. And what's very important in doing the due diligence is you really have to understand the equipment that you're buying because there might not be a lot of equity in the business because maybe the owner has been doing dividends every year. So essentially what they're really doing is they're dividending out their purchase price every year. And there might not be a lot of equity. Yeah, maybe they don't have a lot of debt, but if the average age of the truck that you're buying is 7 years and the average age of a trailer is 9, we are very careful to make sure that we understand what the CapEx allowance on that is. So a lot of times that's also an impediment to doing a deal because owners don't understand that, you know, their equipment isn't supporting the purchase price. And we're not going to, you know, effectively buy a company where, okay, yeah, here's your, you know, here's a really good deal. I'm buying them for, let's say, only a 4x multiple, but they only have, you know, they have very little in retained earnings. And then, you know, you're basically sitting there working out within the first 6 to 12 months, you're basically replacing all of their equipment, which is worth another 2 multiples. And now in reality, you're paying 6.5. And now you're basically eroding down to a very low ROI because you're bordering, you know, essentially basically a cash neutral deal. What's the point? You know, you're throwing on there a 2 or 3 turns of goodwill, and you know, you're not going to ever make that back. So you have to be really, really careful with that. In terms of metrics, I do like a lot of equity in the deals, so that I don't like a lot of goodwill. We're typically unable to buy something, you know, put it through the model, if you end up with less than a 14 or 15% ROI on a discounted cash flow basis, which is tough to do in trucking, then, you know, anything more than a 1 or 2 turns on goodwill will usually erode that. So the metric is that I will pay cash to, you know, a little bit beyond the net book value. And then what we like to do is some kind of a mix of a VTB earnout or maybe even a little bit of shares on the goodwill portion. And so the reason that we do it that way is because that gives us control over the post-acquisition period. Usually there's that first 3 to 6 months, which is when basically, you know, a certain amount of reality comes out of the woodwork, and we're protecting the shareholders. So if we've got a VTB in shares that's locked in escrow for the first 6 to 12 months, then if anything strange happens on an after the fact, or if there's some sort of a working capital adjustment or whatever, then we're holding the recourse and we don't have to worry about it. We don't have to go chasing it, right? So that's typically what we'll do. The goodwill will typically be the non-cash portion.
So the next question is, your return on equity appears to be 2.1%, and your return on invested capital appears to be 0.8% on a trailing 12-month basis. Do you agree with these estimates, and what can be done to increase these metrics?
Yeah, do you want to just pull the numbers on that? Yeah, all right. So, those do appear a little low, but again, I think that's just, again, because of the fact that you're dealing with, a capital-intensive business, and depreciating trucks it's not like depreciating manufacturing equipment. But yeah, we feel that with economies of scale, we can increase those numbers, and especially if we continue to grow our brokerage, because that's not asset-based. So I think you'll see an increase on both the return on invested capital and return on equity. So especially because for the first time in 5 years, we are now in a positive net working capital position.
Just from a maintenance CapEx standpoint, with 500 tractors valued at $180,000 per tractor, which would imply $90 million, to buy a new truck on an 8-year life cycle implies sustainable CapEx at roughly $11.3 million per year. Is that in the right ballpark?
Yeah. Yes. So if we generate anywhere from 18 to 20 million per year of net free cash flow, then essentially we're going to be spending around $12 million a year on sustainable CapEx. But you're right, 180 per tractor, but then that's not taking into account the residuals, right? So really there is a net residual on selling the older equipment, and then the differential is what you're financing. So you're absolutely right. Sustainable CapEx on a tractor is 180. It is about it's 10 to 12 million per year, depending.
Last question here. The stock price is materially undervaluing the company based on current and next 12-month fundamentals. You're under-levered in anticipation of M&A, but now you're viewed by the market as a target, not an acquirer. If you wish to stay an independent company, what will you do differently over the next 3 to 6 months?
Well, that's actually a really, really good question. I like that question because it's been a very, very large discussion, obviously, this year. Our goal in 2020 prior to COVID was to do a transformative acquisition. We're still heavily pursuing that. I would say the M&A activity that's been going on the last few months has been very, very robust. I haven't seen this kind of interest in quite some time. As you can see, even my acquiring competitors, I think, are struggling to find at this stage good targets and substantive targets. Like fairly small ones right now. But having said that, the truth is that I really believe that COVID has simply caused a lot of companies to pull forward and really fast forward and reevaluate their strategy, which is, do I keep it? Don't I keep it? And I need to reinvest in equipment as other companies are stuck having to make those decisions as well. We can prevent a hostile at this point in time if necessary, just because we have the voting capability. But that's not a reason, obviously. So I think from that point of view, what motivates me is that at any point in time, I feel that I have to make a decision, which is, where am I going to utilize my shareholders' money best, right? I.e., do I keep their money at this stage, or do I just give them the hostile? Because at this point in time, the hostile is going to be a hell of a lot higher than what we're currently trading at. All right. So if you were to look at a negotiated deal based on a multiple that's appropriate for a company like Titanium and one of our size. So if you look at us, we're ranked 25th in Canada, but that's just based on trucks and trailers. And if you add in there the brokerage revenue that we're generating on a non-levered basis, we're probably more like anywhere from I would guess around 18, 17, maybe 16th largest company in Canada. So, and with our sophistication in tech, I think you're right, we would be more than likely a target. Having said that, I look at that and say, okay, as a target, I'm going to get X dollars for my shareholders as a premium purchase, right? On the other hand, if I don't want to do that, am I doing any justice to my shareholders by keeping that money? So the decision that I'm making at this point in time is, what can I do in the next 3 to 6 months to make sure that I can give my shareholders a rate of return one way or the other, right? I really need to get to that acquisition. I need to deploy that capital, and I need to make sure that I give my shareholders, instead of, hey, here's your money back, you know what, before I do that, actually I need to keep growing and I need to hit that $400 or $500 million target. And you know what, and eventually, you know what, I don't want to get taken out, in the mid twos. If you work through the math, I'm sure everyone is at this point in time. Obviously the question is demonstrating that. But you know what, I can get you a $3.50 or a $4 or a $5 stock, because guess what, I'm able to now execute on the acquisition, on the cash, and I'm able to get you a way better rate of return by keeping your money and using it for, for acquiring companies. So clearly, I am very aware of that. I'm very aware that it's kind of like, it's at the investor level, it's your make or buy, right? Do I keep the money and use it more wisely, or do I give the money back and say, you know what, guys, I can't get you more than a 10% organic rate of return for the next 5 years. I'm not able to buy anything. You know what? Here's your money. Go and find other opportunities that are going to get you 25 or 30%.
Great. Well, thanks, Ted, and
Yeah.
thank you also, Marilyn and Alex, for taking the time today to provide the update. And thanks for everyone for joining. If you'd like to ask any further questions, please don't hesitate to reach out to either myself or Ted, and our contact info can be found at the end of the presentation deck.
Thank you.
Thank you. Thank you, everyone, for attending, and thanks, Jason and Deborah, for organizing this event.